Perfect. All right. Thanks again, Paul, for being here. I know we met almost 2 years ago at the Best Ever Conference and have stayed in touch. And so, first of all, appreciate you staying in touch. And it's great to be here to have you on the show and on this webinar. So we started doing this webinar almost 2.5 years ago, and then we took a little bit of a break. But this year, we have decided to stay consistent and launch a monthly webinar to basically just provide free education to our existing investors or also new people coming into our fold, friends and family. I've often noticed that there are people who they follow you, they're reading every post, they don't like and comment, but they're watching you. And if you throw out free content out there, they're consuming that content. And if this helps even 2, 3 people, I think that's a win. So I think with that, I'm going to pass it over to you, Paul. The topic for today, of course, is learning to invest in real estate and other alternative investments using self-directed IRAs and solo 401ks. So over to you, Paul. If you could just quickly introduce yourself and away.
Thank you very much, Jay. I want to take a moment to, first of all, thank you, your partner, Andy, as well as the rest of the team over at Prosper Capital. What we're going to be going ahead and diving into today is we're going to learn how to access tools that the wealthy have been using since the 70s. So for over 50 years, people have been going ahead using their retirement funds to invest into alternative assets, specifically real estate. Let me go ahead and share my screen here so we can dive in how we can go ahead, unlock these retirement funds to expand our real estate portfolios. The first thing I want to dive into tonight is a little bit about us, a little bit about our history. As Jay mentioned, my name is Paul. I work here in Sioux Falls, South Dakota, where we're chartered with the South Dakota Division of Banking. And that's what we are on paper is we're a bank. Formerly, I worked for a company called Midland Trust Company, which was a custodian, that being a bank that holds alternative asset investments. And we'll get into all the different types of alternative assets here in a little bit this evening. We were acquired in August of 2023. That's when we went ahead, rebranded from Midland Trust Company to Equity Institutional Services. And there are a few different pillars on why we were acquired back in 2023. The first pillar is going to be due to our ability to also serve as a qualified intermediary. So we also help assist clients with 1031 exchanges when it comes to real estate investing, ensuring we can help them defer those capital gains taxes along the way. Equity Trust was very interested in doing that, not only helping people defer those taxes inside retirement accounts, but outside of them as well. The other primary reason being in that we really specialize in private equity investments, specifically real estate syndications. So much to the point where Forbes Advisor that same year had actually rated Midland Trust as the best custodian to use for these different private equity investments. And we differ quite drastically here on the Equity Institutional Services team as compared to other custodians in the industry. When clients work with Equity Institutional Services, they have a dedicated point of contact in their client service representative. Most custodians, you would go ahead, pick up the phone and press 1 if, press 2 if, press 3 if. It's going to be a huge differentiating factor between our groups and others. It is going to be that white glove client service that's going to be provided. The way we're able to go ahead and provide that is we are the largest custodian of alternative assets. I know this screen says 77 billion. It's since swelled to 81. $81 billion under our custody and administration. That being said, we're also the oldest in business at 52 years as well. We have a few different offices. Once again, I'm here in Sioux Falls. We have another office in Chicago that handles a lot of our relationships with registered investment advisors and family offices, helping them satisfy the custody rule with the SEC. We'll also go ahead, have an office in Fort Myers, Florida, where a lot of our 1031 exchange team will reside. And then, of course, headquartered in Cleveland, Ohio, off there on the left-hand side, where our beautiful office is located just outside Westlake. So what is a self-directed IRA? This is a term I I constantly hear over and over every day I wake up. And a self-directed IRA is an IRA just like any other. It has the same exact rules and same exact limitations. Now, what's really going to differ here is what is that custodian going to allow you to invest into? If you take a look at other custodians, Fidelity, Schwab, JP Morgan, T. Rowe Price, the list goes on and on. Those are going to be more traditional custodians that are focused on the public markets specifically. Those being mutual traded funds, exchange traded funds, CDs, bonds, annuities, and the like. Those custodians are concerned with AUM, which stands for assets under management. That's how they're compensated. They get 2% of that for going ahead managing your portfolio, and then another 20% on the returns inside that portfolio as well. They are heavily incentivized to go ahead and get you into their own proprietary products. Where here at Equity Institutional Services, we remove that barrier. We help clients go ahead and get invested into those assets they want access to. We're concerned with AUC, that being assets under custody. We want to go ahead and be the bank in this process. We want to hold it on your behalf for the IRS requirement to go ahead and get you invested. So we're not actually managing where the funds are going. Our clients are completely doing that for all $81 billion of assets under custody. And it really opens up your investment options. Rather than going ahead and remaining siloed in the public markets, you can go ahead, use these funds to invest into alternative assets like real estate syndications, real estate funds, real estate property, secured notes with third parties that are secured by real estate. Even unsecured notes are able to be used to invest in with an IRA. Other items, futures trading, foreign exchange trading, precious metals, cryptocurrency, the list goes on and on. Now, what can you not invest into with when it comes to an SDIRA? You would not want to go ahead, purchase a life insurance policy, invest into some S corporation stock due to the tax advantages it already receives, or make an investment into anything currently federally illegal, like cannabis at this time. Now, if that were to change, I'm sure the laws surrounding it would be subject to change as well. But there are many, many different options when it comes to investing alternatively. That being said, those financial advisors, those fiduciaries at those current custodians have a financial incentive to go ahead and keep you in those public markets. So make sure to keep that in mind when you're having a conversation with them. I also want to take a beat here because there is a misconception when it comes to the public markets and being well diversified. A lot of investors think, hey, I'm invested in a mutually traded fund and an exchange traded fund. There's my diversification of assets. Well, in all reality, both of those offerings more than likely hold a large portion of large cap US stock. At the end of the day, they're in different vehicles, but you still have the same risk exposure as compared to going ahead, hedging against the public markets, moving those assets into the private markets where they're not going to be affected so much due to different items such as geopolitical events. That self-directed, truly a marketing term. I've even seen some of those traditional custodians use that self-directed verbiage to confuse their clients. They'll say, yeah, you have a self-directed IRA, but you can only invest in these eight mutually traded funds. So be careful when it comes to naming conventions, right? You really want to ask your custodian the question, hey, can I invest in alternative assets? Not, hey, can I invest into a real estate global index fund? But hey, can I actually purchase real estate with this account? And I've had that with an investor. They were invested into an international real estate fund, and I asked them, "Hey, what countries are these? What countries are you vested in? Where are they placed?" The individual had no idea, right? Neither did their financial advisor. So always ensure you know where these dollars are going. At times, they can be forgotten. A lot of people will forget that they have these 401k accounts, even when they change employers. And we'll get into that here in a little bit. Bottom line, though, A custodian is needed. It is an IRS requirement. You'll need one to go ahead and place these retirement funds. Now, one of the first things I want to speak to tonight are the tax advantages associated with going ahead and making investments out of retirement vehicles. The biggest one by far is that you're not subject to capital gains taxes in your returns, which allows for compounding wealth inside these either tax deferred or tax free vehicles. And we're going to get into the difference between the two here later on. As we touched on, so many more investment options. When you have a true self-directed IRA, you can go ahead, get into many different asset classes. Our administrative fees are another reason that people will seriously consider a self-directed IRA is because they are flat and fixed. Most investors, when they're investing into one asset, will go ahead and pay $555 in first year fees and then $350 annually thereafter. We don't charge basis points. And then, of course, the diversification aspect, right? So many different Americans, specifically millionaires in America, this is where their investable wealth is, over 70% of it. This is where they can actually go ahead and garner a good return and do so with enough funds to really change their life trajectory. Now, a lot of different people are going to go ahead and have it ride in the public markets because that's what their parents did for 50 years. And that's all they've known. I'm here to tell you today, you don't have to be a part of that same group. Rather, you do have the option to go ahead and start moving funds over into these alternative assets so that you're actually truly diversified rather than having all those holdings off in those public entities. Now, a few different reasons people will pick up the telephone and give me a call when they're looking to create these accounts. The number one reason by far is because they change employers. Here in 2026, the world looks a lot different than it did in the 70s and 80s. People do not work for the same employer for 10, 20, 30 years anymore. Rather, they frequently job hop every 3 to 5 years to increase that base salary and their standard of living. When they're able to go ahead and change those employers, they now have access into those funds. And we're going to cover that later in a direct rollover, where you can now go ahead, deploy that capital. Now, write this part down if you have an active employer and a 401k with them. You want to ask them if you can commit an in-service rollover. An in-service rollover. Most of the time, over 90%, they're going to tell you no. Hey, you're not able to go ahead and use those funds. But from time to time, they will allow individuals to go ahead, take those funds out of an active 401k and move them into an IRA vehicle. Now, that typically has to do with tenure at the entity as well as age of that employee. But it's a question worth asking because if they tell you no, you're in that same exact seat you were 10 seconds before you had even asked the question. It's something to at least check in on. Illiquidity being another reason, right? Maybe you're a serial investor and you've already committed to 3 or 4 different deals this calendar year at the end of quarter 1. Well, here's a way you could go ahead and commit to another if you feel passionately about it. Here's a way to go ahead, actually commit capital in that tax advantage position to where you're now able to go ahead and compound. Here are a few different retirement plans that I want to make sure I'm taking a beat on tonight to go ahead and cover. The 401k, most people are familiar with, right? It's an industry-leading product due to its affordability. It's very easy for these large companies to go ahead and set up. That's going to be reserved for those who are typically in a trader business, right? Now, the 457B, that's going to be a governmental plan. So think of your local officials, firefighters, police officers, prison guards, correctional officers, your mayor, right? They're gonna be privy to these 457B accounts that can also be rolled over. The 403Bs, those are going to be reserved for 501(c) employees and those who work for education system. So your local teachers as well are going to be the ones who have these 403B plans. There's also another not on this screen, a thrift savings plan. That's for uniformed guard members. So those who have served our country, whether it be for one of our armed force branches Or maybe they reside stateside and work for another three-letter acronym agency, such as the CIA, FBI, or IRS. Qualified annuities, I've also seen rolled over. In addition to that, defined benefit plans. Many different retirement accounts can be used to go ahead and fund these real estate investments. Now, as we dive into IRAs, most of you are going to be familiar with the traditional IRA. It's been around for quite some time. It's that pre-tax account, and an important age to make sure to keep in mind with these traditional IRAs and all of these IRAs is 59 and a half. That's the magic number. That's known as the age of distribution when you can start tapping into these retirement funds without creating said taxable event. Now, with the traditional, the SEP and the simple, these are pre-tax in nature. So when you pull them out post 59 and a half, they're going to be taxed at the ordinary income rate. Still a huge benefit when going ahead and using these to invest because we're avoiding that capital gains tax and allowing the creation of that wealth in that tax deferred system. This in regards to that traditional IRA, there's also a thing known as required minimum distribution. Now that happens in your 70s. What's going to happen is the IRS is going to tap you on the shoulder, Uncle Sam, and he's going to say, "Hey, I need some tax revenue." That's when you're going to need to start dwindling that account. Now, the great thing about self-directed IRAs is even if you're at that age 73, you can still have that holding, that real estate investment, still satisfy these RMDs from another IRA account. That's one of the beautiful things about required minimum distributions is you can have multiple IRAs out there, but satisfy that limit out of one IRA. The contribution limit for that traditional IRA is going to be capped at $7,500, 8,600 if you're over 50, do that catch-up contribution. The Roth IRA is going to be an awesome post-tax vehicle where you're able to go ahead and pay taxes on that seed, on that initial seed, but then go ahead and create a tax-free environment, which is very attractive, where you're not going to be going ahead paying those capital gains taxes and then also not paying those ordinary income taxes post 59 and a half when you're ready to go ahead, pull those funds out, get access to them. The SEP IRA stands for a simplified employee pension. Now that the SEP and the simple are going to be reserved for business owners. The SEP is going to have a very high contribution limit at $72,000 or 25% of compensation, whichever one is going to be lesser of the two. The simple IRA stands for Savings Incentive Match Plan for employees, and that simple IRA is going to have a much lower contribution of $17,000, but is still another pre-tax option account for those business owners. Now, later tonight, we're going to dive into a solo 401k, which has really placed these two plans to the wayside within the past couple of years. Now, they still may be appropriate for those who do not qualify for the solo 401k, as those have special considerations that need to be followed as well. An inherited IRA is another type of IRA account that one can receive once when your loved one passes away. Now, if you inherit the IRA, you have a 10-year timeline to fully distribute that account, unless you're a spouse. So those of us with spouses, super important when you're creating that beneficiary form that your spouse is listed as 1A. That way, if you were to pass, they would then inherit it and have a very easy time in transferring it into their IRA account where those funds are now theirs and they're not subject to that window. So making sure we want to list those spouses in that beneficiary form. Other accounts that can be used to self-direct funds that most people are unaware of, an HSA, a health savings account, right? So typically people think this is for medical expenses, which it is typically used for. So think about those medical deductibles, prescriptions, right? What have you, any of those costs that are incumbent of our health, right? Now, I've seen groups, people who have families, go ahead and they've had healthy families, thankfully. They're very active. They're always outside walking their dogs. Yeah, they get out a lot with their kids. Thankfully, they've also avoided any major surgeries, but they've actually use those funds to go ahead and make a $100,000 investment into a real estate syndication, which is amazing to see. An ESA would be the other type of account, a Coverdale Education Savings Account. Very similar to that HSA, except people use it for those tuition costs, right? Books, room and board, all of those pertinent costs that come with educating a child, right? Um, Another option when it comes to self-directing funds. Now, on this screen, we'll actually be able to go ahead and take a look at all the different employer plans that can get rolled over into that traditional IRA. Now, when we move funds like this, it's known as a direct rollover. There's two types of rollovers. One's a direct rollover and one's an indirect rollover. We'll always want to do a direct rollover. That's from one financial institution to another. You're allowed one indirect rollover every rolling 365 days. What an indirect rollover is when rather than having funds sent from one financial institution to another, you would personally take receipt of the funds and then have 60 days to go ahead and get them over to us in the IRA account. That's going to be the time window you would have. We want to avoid that because you're only allowed one of them every year. So we would ensure a direct rollover takes place. We would provide you with a detailed PDF with our delivery instructions and then that account number as well. And they'll actually send a physical check in the mail and make it payable to Equity Trust Company as custodian for benefit of Paul Herbis, account number 12345. Because that's going to be the actual subscriber into this real estate investment. And we'll get to that here in a little bit as well. Here's what it would look from those Roth rollovers. Same scenario here with the direct. Now, these trustee to trustee, IRA to IRA transfers, they differ a little bit. Now, with the IRA transfer, the receiving custodian actually initiates the process. So we would help you go ahead, establish that self-directed IRA account, and then have you complete a transfer form. Some custodians require a pen signature, some accept electronic signature. Some custodians may require an account statement, some do not. I'll be able to personally go over that with you to ensure we're on the right path and making a timely investment. After we have those necessary items, we would then submit to your current custodian. Now, a wrinkle in this is we operate off of what's known as the non-ACAT transfer system, which means we completely specialize in the world of private investments. We do not hold public investments. We're not a broker-dealer ourselves. That being said, the client would need to go ahead and liquidate those current positions. More than likely, your IRA or 401k, well, using the IRA as an example, it probably holds a mutual fund investment or an exchange traded fund. You would need to go ahead, sell that portion, move it into a sweep account, a money market account for funds to settle, and that'll take 24 hours. Once when that happens, we can then go ahead and send the request. Otherwise, the other custodian is going to gladly deny our transfer request due to insufficient liquid funds so that they can go ahead and hold on to those assets under management for another couple of business days because they're a bank and they want to hold those assets. Roth is very simple. You're only able to move from Roth to Roth. There's not other accounts that are able to enter the fold. Keeps things very streamlined. You need to use a custodian. Some considerations used with these SDIRAs. It's not a recommendation. The actual entity investing through a typical self-directed IRA is that IRA entity. So it's important to understand when it comes to the subscriber process. It's not you investing personally, rather it's your IRA on behalf of you investing. The IRA is the one going ahead making that investment. It's also going to be the one receiving those returns. So cash flow needs to follow in that order of operations. Lead time, it depends based on how we're funding the account. If we're doing a direct rollover from an employer plan, it's typically going to take 3 weeks because they'll actually send that physical check in the mail and we'll hold on to it for 5 business days until it clears. The IRA to IRA transfer, much quicker 2-week process because it's handled electronically. There's no hold time for that check. And as I mentioned, an in-service rollover is going to be the term you'll want to ask your active 401k plan administrator to see if we can go ahead and move those funds over. Simple three-step process. Open the account, fund the account, make the investment. We'll be able to assist you every step of the way. Now, what I want to pivot into tonight is known as a checkbook IRA. And it's a similar IRA vehicle. Rather, it's an IRA that owns a single manager managed LLC. And what this does is it provides protection, not only for that IRA account owner, but for the IRA itself. This is going to go ahead and actually create a limited liability veil to go ahead and protect you. This is critical if you're investing in real estate property. Absolutely critical. If it has to do with a tenant and you want a veil protecting you personally. I live here in Sioux Falls, South Dakota. There's lots of icy sidewalks, icy stairs, and the like. Important thing to consider. That being said, if you're somebody who likes to move quickly, which a lot of things in the real estate world happen very, very quickly, you would want to consider this checkbook IRA because it's going to give you full transacting power. You would not need to wait on a third-party custodian. Rather, as the name implies, you would actually have check writing abilities, a bank account owned by that LLC that you can effectively manage and make investments as you best see fit. Now, we can certainly help assist here. Going ahead, standing it up with the articles of organization, the operating agreement, the EIN, initially filing with the state, connecting the bank. Certainly something we could go ahead and help with when it comes to a lift. But if you're an experienced attorney, certainly something you could create on your own as well. Now, for those visual learners out here, here's a graph of what it would actually look like, right? So we would go ahead, help you establish the single member LLC, and it's important to be aware that when we're going ahead and establishing this, as I'll just try to move this quickly. I'm sorry, guys. It's just distracting me here. My apologies. Um, as we're looking at this, it's really important to keep in mind the cash flow, right? Because this is where mistakes can be made. And I want to ensure the guardrails are in place so that those mistakes don't happen. When you're going ahead and making contributions and distributions, super important to still involve us as the custodian. So let's say I'm past 59 and a half, that age of distribution. My real estate investment's doing well, and I want to go ahead and spoil my grandkids at Disney. That's what I want to do this weekend. I want to grab some tickets and go have some fun. What I would do is I would actually send a wire back from this LLC bank account to my IRA to have that reportable distribution through the custodian. We would then go ahead, wire funds from your IRA account to your personal checkings or savings. And the same is true when you're looking to do a contribution for a current tax year. You would never want to commingle your funds and have funds sent directly from your personal checkings and savings into this LLC bank account. Rather, you want to ensure you're using that custodian as that layer, contributing directly to us so we can report it to the IRS, and then instructing us to send it via ACH or wire over to that bank account to make that investment. Now, some things I'd like to call out right away are going to be disqualified parties. And those are people that the IRS comes right out forthright and says, hey, these are the parties you're not able to go ahead and transact with. The first one's going to be myself. So you would be a disqualified party to yourself. And what do I mean by that? You would not be able to go ahead, and let's say I personally own some land. I would not be able to sell my land to my own IRA. The same applies to my spouse, my parents and grandparents, and then any of my kids and their offspring as well. So my kids, their great grandkids, their forth on. And the same is true of any entity that they're controlling, right? Any entity that they have that 50% or more ownership in. The same applies with my credit, right? So let's say I want to go ahead, get a non-recourse loan. That would be the only loan available to me if I want to go ahead and purchase real estate property. I would not be able to sign a personal guarantee on behalf of my own IRA's investment because it's my IRA placing the capital, not myself. And then the same is true of any sweat equity, is what I like to call it. Say I purchase a single family home, the roof starts leaking. I have experience in roofing. I would not be able to jump up on there and start tacking shingles down, nor would any of these parties. I would need to go ahead, find somebody who's not a disqualified party or that third party arm's length distant vendor to go ahead and complete that work. Other items to keep in mind, as we touched on, no commingling of funds, and then the responsibility of this all. You now are a manager of an LLC. So you want to keep an active inventory of your credits and debits to and from that bank account. You want to make sure that you have those records. And then, of course, that personal oversight of the LLC. It's an active LLC. You'll want to continue registering it with the state on an ongoing basis. The steps here are very similar to the steps of creating that self-directed IRA. The wrinkle is going ahead and creating that newly formed entity. And it will need to be an LLC with no past business activity. I know a lot of people constantly ask me, hey, Paul, I got this LLC. It didn't really work out. I had a business idea, didn't really happen, but I still have the active LLC. Can I use it? And the answer is no. You need to go ahead, have that newly created entity. Only purpose it's going to have is for that IRA. But that's something we can do simultaneously as we wait for funds to be received. So let's say you're moving from an employer plan, doing a 401k rollover. While we're waiting for those funds to get sent, that check to be delivered, the holding time for that check, we can work with you to go ahead and get that checkbook IRA off the ground. That way, by the time we actually receive those funds, they're deposited, you're ready to hit the ground running. Now, this account here has been a flagship account over the past couple of years. And the reason for it is the very, very high contribution limits. The solo 401k is capped at $72,000. So with that, you can go ahead and fund, or typically you can go ahead and fund a real estate syndication investment just off a contribution alone without even needing to go ahead and pull from other retirement accounts, which is an incredible tool in itself. So many different accounts can get rolled over into this plan, but I want to spend time on highlighting the one that can't, and that's the Roth IRA. It's the only account you're not able to go ahead and push into the solo 401k vehicle. The reason for it is the solo 401k used to have required minimum distributions. Roth IRAs don't have them. That's why they segmented this. Here's a part we're really going to cover tonight here in depth is those in-plan conversions. This is the part of the solo 401k where things get very interesting very quickly, where you're really able to go ahead and gamify the system to create those post-tax funds to really go ahead and accelerate your real estate wealth building journey. As you'll see on the screen here, and something else I do want to call out, those simple IRAs have seasoning periods of 2 years. So you're not able to transfer or roll those over until that account has been open for 2 years. Here are those different contribution limits when it comes to these solo 401k accounts. As you'll see, there's actually 3 different buckets that make up that total contribution limit. The first is that employee deferral. The second is the employee profit sharing. And the third is going to be the employee non-deductible contribution, which is an awesome part of our plan. Not all plans have that third portion, guys, which is an awesome, awesome tool that'll allow you to go ahead and hit that contribution limit, even if you haven't cleared the 72,000 yet, which is a huge differentiator between that SEP IRA. As you'll see here, there's also the catch-up contribution limit, right? So if you're older than 50 plus, you're able to actually go ahead and accelerate that. And even more if you're in that age range of 60 to 63. Now, really important when considering all of this, we need to keep in mind tax deadlines, guys, specifically with the solo 401k account. IRAs are much, much simpler. There's a lot more moving parts with the solo 401k because remember, there's 3 different buckets we're filling up now, right? Now, Two of those three buckets, the employee deferral and the employee non-deductible, they're gonna go ahead and be in their own timing bracket. And that's gonna be for those sole proprietors and those single member LLCs, that's gonna be tax day, April 15th. But it's gonna differ based on what type of entity you have that's sponsoring the solo 401k plan. If you have a corporation, then we need to make sure that those deferral elections are actually completed end of year. Got to make sure that that is happening. And then even when that happens, you only have 7 business days where you need to go ahead and get those funds deposited. Now that employee profit sharing portion, that is going to be a little funnier with those S corps because they have their own special tax days, right? March 15th and then September 15th. Um, with the sole proprietor, single member LLCs, if you go ahead and miss tax day, you can still go ahead, contribute to the employee profit sharing if you go ahead and file that extension, right? It buys you some more time. C Corps, it's going to be very similar. You can go ahead, extend to October 15th as well. Now, there are requirements when it comes to the solo 401k plan, right? Not everybody qualifies for it. Otherwise, these would be the only type of accounts to exist. Um, you can't have any other employees, right? And that's what makes this tricky is you need to go ahead and you need to be a solopreneur. Now, there are exceptions, right? Such as your spouse, they're able to be employed by the business as well. Any of those business owners, if they contain more than 5% of ownership, can be included too. And then there are some special stipulations when it comes to those workers, depending on how many hours they worked or how many days they've worked. That being said, they can't be employed when you're going ahead and starting the plan, right? They can get added later into it, but they can't be rank and file when we're going ahead and creating this account. And of course, we need to earn income, guys. IRAs, 401ks, we need earned income to be able to contribute to it. That is a stipulation. We're going to dive next into control groups, and we'll highlight how that actually affects your eligibility here with the solo 401k for those here in attendance who are multiple business owners. Before we do that, though, I do want to take a beat on this page because if you got kiddos and they're under 21, they're automatically considered owners. So you can still have the solo with them on board. But when it comes to control groups, this situation here on this screen would not be allowed. And what that situation would look like is somebody who owns multiple businesses. So they own business A, they have employees that are rank and file at business A, but they also own business B where they don't have any employees, right? The IRS is going to go ahead and put this to a control group test. And if you or your spouse, we're including spouse ownership too, if you guys combined own over that 80% threshold, we now have that control group issue where you're not going to be able to go ahead and qualify for the solo 401k. But if it's under that 80% threshold and you're still a majority owner at 50%, you would qualify for it because that threshold is going to be an 80% limit, right? So you could still be a majority owner in 2 businesses and not be in a control group, which is where this can get confusing for people. 80% is that limit, guys. Make sure we write that down. That would be the point to remember. Now, I touched on that non-deductible employee contribution. That is a stellar part of our plan. And not every solo 401k plan has that going on for them. Other items that we have in our specific plan is going to be that Roth conversion feature, which we're going to touch on here later, as well as a loan feature. So you can actually get a loan from your solo 401k as well. You can get a 5-year loan, or you can even get a 30-year loan on a residence, right? Now that interest rate is going to be a little higher. It's going to be prime plus 1%, but you're actually paying back that 401k account. And there's been some very unique strategies I've seen used there to go ahead and subvert some disqualified party transactions. Now, who we use to go ahead and provide these documents is PenServe Pro. That's who we use to go ahead and actually be our plan document provider. And they're the ones that have an actual IRS opinion letter that have approved the solo 401k plan we have, which is that document that'll go ahead and say, hey, the solo 401k plan is great to go. It follows that Internal Revenue Code policy. Now, a stark difference between the solo and the IRA is we're not actually the custodian of that solo 401k. You as the individual would be. So you do not need to hold the plan assets with us, which makes for much easier transacting. It gives you that checkbook control without needing to form the single member LLC, where you now still have that same bank account connectivity where you could go ahead and invest into any asset of your choosing, what that may be. And it's very easy to go ahead and actually reconcile as well. I like to call it the QuickBooks of solo 401k. That's the record keeping system we use through SEP IRA-K is the name of the entity. Makes it very seamless to go ahead, reconcile your transactions, and it'll actually prepare a form for you as well, depending on the valuation of that solo 401k. If your solo 401k has more than $250,000 worth of assets, that $250,000 threshold, you'll then have to file what's known as Form 5500 EZ. Now, with our product, with that solo 401k, through the record keeping system, it automatically prepares it for you as you're going through online and reconciling things. So it's as easy as going ahead, printing off a PDF and forwarding it to your CPA to go ahead and electronically file on your behalf. Now, this is the part I'm very, very excited for. And this is where we're going to go ahead and talk about Roth conversions. This is where we're going to discuss how we're going to go ahead, push those pre-tax funds into a post-tax position and really create compounding interest in the absence of taxation. Now, before we dive into solo 401ks here, excuse me, I want to take a beat on IRAs. And this has been out since 2010, what's known as the backdoor Roth conversion. It's been around now for 16 years already. Now, what this is a lot of people aren't able to directly contribute to a Roth because there's what's known as a modified adjusted gross income limit, which says, hey, if I'm too high of an earner, I don't have the advantage of going ahead and contributing to a post-tax account. Well, since 2010, you've been able to go ahead and create a traditional IRA, which has no income limit, create a Roth IRA, and then do a Roth conversion. Intentionally create a taxable event to push this seed money into a post-tax position, pay the ordinary income taxes on it initially when you go to file on April 15th to allow for this growth to go ahead and be tax-free. Now, what does that actually take? After both accounts are opened, you'd fill out a Roth conversion form. We would go ahead and send a copy of that 1099-R over to the IRS and you, and the same as that Form 5498, which is going to go ahead and document that Roth conversion. An amazing, amazing tool. Now, on the bottom here, it'll briefly touch on discount conversions. We'll dive headfirst into that here in a second. Now, as you're doing these Roth conversions, and as you're doing rollovers as well, right? There's not a defined maximum limit you're able to do. And there's not a defined minimum limit you need to do. And you're able to do this as many times as you would like throughout the year, so long as you do it before end of year, right? So you need to do this in the current year you're in, but you're able to do this as many times as you'd like with as little or as much cash as you'd like, not needing to withhold for those taxes. Now, this is a fun graph right here. So this is going to show a little bit of the difference here between the traditional compared to the Roth, compared to a taxable account. And it's just absolutely stark in going ahead and allowing not only the contributions, but the earnings to be in that tax-free position. Amazing to see. That compounding interest in the absence of taxation. Now, there's quite a few different strategies around these Roth conversions that people will go ahead and invoke. One is taking a bite of the elephant at a time, going ahead, doing this over a multi-year horizon and going ahead and really calculating into it. We'll go ahead and dive into the one into the one big beautiful bill, what that really changed in our world, and how that's been able to go ahead and help those looking to make those Roth conversions. Other people will go ahead and do it on a deal specific basis. Maybe a deal is more advantageous than another at a specific time due to the fact that it may be regressing in value. Maybe you believe it has a higher future value, and that's really where we're going to see the discount conversion come into effect. And we'll go through an actual side-by-side example of that here in a little bit. Now, what the One Big Beautiful Bill did here this past summer is go ahead and allow for the extension of the Tax Cuts and Jobs Acts. And that opened up these tax brackets for those at a federal income rate. And the amazing thing about that is you're now able to go ahead and convert more dollars into that post-tax position every year. And this is where I'll see the most savvy investors get the furthest ahead, is they are actually gamifying this to the point where they're going ahead, sitting down with their CPA, figuring out for whether it's a head of household or single filer, here's going to be my earned income for the year. And then they're going ahead and figuring out what's the top of that bracket and how much can I convert in a single year to get it into that post-tax position while at the same time ensuring I'm not bumping myself up into a higher tax bracket, right? So they'll contribute here to one of these ceilings in one of these bands, ensuring they're funneling as much money as they can into that post-tax position while also being sensitive to the fact that they're not jumping up into a higher tax rate when they're going ahead and accomplishing that. Now, here is an example of a discount Roth conversion and what that would really look like. What would initially start is the movement of funds. So moving funds over, let's say from a traditional IRA and another custodian, creating the solo 401k account, bringing funds over. You then go ahead, deploy the capital. Let's say in this example, the capital was deployed in a pre-tax position. Well, you can now do what's known as an in-kind Roth conversion. Most of us are hardwired that this conversion needs to take place in the form of cash. In all reality, it does not. You could go ahead and do it with an in-kind holding. So let's say I make that $100,000 investment into a pre-tax position. I would then get with my CPA to find a lower valuation for it. Let's say there's a little blimp in the roadmap, something happens, and we're able to go ahead and reduce that valuation. I would certainly want to do so. I would certainly want to get with my CPA to accomplish this because I've now dropped my basis from 100 grand to 55 grand. I'm now completing that conversion at a 55 grand basis. 55,000 is now what I paid ordinary income taxes on. This holding is now in a post-tax position where those earnings are going to be tax-free, knowing full well that it's going to go ahead and rebound in the future as it's a hard asset that's being held and managed. An amazing way to go ahead, move pre-tax to post-tax while calculating accordingly with our income to make sure that we're keeping as much money into our own pockets to fund more real estate investments. And with that, would absolutely love to go ahead, help open it to a question and answer section. I want to make sure I can get your guys' questions answered and make sure that I'm doing my part here with Equity Trust.
Awesome. This was pretty incredible, Paul, first of all. And I think we can see that this is a pretty complex topic. So if the viewers of this webinar today, if they want to go and get more education, because for example, the Roth conversions, that in itself can be a 2-hour session. So do you guys provide like some sort of
Yes.
educational platform so people can engage with that and get educated and then decide to leverage some of these tools and start working with you all to invest in alternative investments?
Absolutely. Absolutely. I think the best first thing is to have a goals-based conversation. So I would ask anyone interested to go ahead and reach out directly so that I can best understand what you're trying to accomplish. and what you're really looking to achieve. But we have tons of educational resources out there too, if you don't want to have that one-on-one conversation. We got tons of YouTube videos, a whole education suite online dedicated to that, where you're going to be able to go ahead, look through those blogs, through those different articles published by our representatives, and really be able to gain a better holistic understanding. But would totally welcome those who are interested, who do have questions as well, to go ahead and take me up on it, because I'm more than willing to go ahead, get on a Teams meeting, phone call. I am a texter, so you can reach me via text as well. But yeah, would absolutely love to help answer questions and point people in the right direction.
Absolutely. And some of the strategies you mentioned in this presentation, especially that last slide, I think is genius because you adjust your basis to 55K. Now you pay ordinary income tax on that 55K. And now all the future growth is tax free because now it's Roth.
Mm.
So I think that's just phenomenal. Like, so some of these strategy sessions can our investors and people in our network, can they have these directly with you, or is their CPA also a good resource and the CPAs typically have this knowledge as well? Or what's
Yeah,
kind of your recommendation in terms of
yeah.
where to get started for someone who does not have exposure to some of this stuff?
Yeah, I'm certainly willing and able to make referrals. So I
Okay.
am very well aware of a CPA who would absolutely love the opportunity to help assist. And while I don't make any endorsements or elections and I don't give tax and legal advice, I can certainly connect people, right? I am a connector. So yeah,
Awesome.
would love to help any of the lovely folks here in that way too.
Sweet. Well, folks on the call, you can drop your questions in the chat box or even unmute yourself and ask a question if there are any questions. So, and I'm gonna see if there are any questions from the audience.
Of course, but you make a great point, Jay, and that's not all CPAs are alike, right? You
Yep,
want to specifically find a real estate CPA.
absolutely. Yep. And even within real estate, it's so vast that one CPA may not be able to tell you all the strategies, you know. I have a great CPA, real estate focused, and he tells me a lot of different things. But some CPAs may tell you their favorite strategies, but they may not tell you about all the strategies. So I think as an investor, it's really our job to educate ourselves on what's out there, so we can actually assess what best fits our scenario and our planning or financial planning. I think I'm a huge proponent of learning things yourself. Advisors are always great, of course, but now one of the things that you mentioned, Paul, in terms of the IRA was like you cannot invest in something where your parents or your grandchildren are members and stuff like that. So essentially, like, can I create a self-directed IRA and use those funds to work on a flip that I'm working on myself, or an
Mm,
Airbnb that I'm actively managing? Or does it have to be an investment that I'm passively involved in?
amazing question, Jay. And truly, it's going to be that latter. It's going to be the
Yeah,
passive one, because
correct.
we're not able to perform that quote unquote sweat equity, right?
Yes,
So if you're going ahead and performing more than what I would consider managerial duties, if you're running this as an active business, right? Well, then we've just crossed a threshold.
right.
Now, if you're not if you're not working on that active flip yourself, but you're contracting it out to a third party, or let's say you're just lining up the tenants, right? You're just finding occupancy, that's the only issue you're really solving for, would
Mhm.
not be disqualified. But
Got it.
if you're leaning into it, if you're flipping, if you're an active flipper, well, now you're running a business, right?
Correct. Yeah. So it's got to be like arm's length distance. So you invest with an operator where you're not
That's
actively
right.
managing that capital. Got it.
No
Makes
personal
sense.
benefit to the property, right? So I'll give another example. I'm an avid outdoorsman. I'm here in Sioux Falls, South. There's not a lot to do except be an avid outdoorsman here.
Yep.
I'll be very brazen. Um, I purchased land with my IRA. I would not be able to go ahead, hunt and fish on that land. I would not be able to personally enjoy it, which I know is a huge deal breaker for a lot of land investors, but it's the
Yeah.
reality of things. You need to be using it as an investment property.
Interesting. Okay, that's good to know. And I see a lot of people these days are also buying businesses, like buying a
Mhm.
trades business, buying a HVAC company or a roofing business, etc. The business or ETA, entrepreneurship through acquisition, is a very popular concept today. And I do
Mhm.
see some people tapping into their 401ks. So do you think
Mhm.
that's using a loan against their 401k and not really a solo 401k? Because with solo 401k, you cannot invest it in a business that you're an active partner on, correct?
Yeah, we want it to
Yeah.
be passive. We want it to be
Got it.
passive at arm's length, really through its entirety. Because
Yeah.
at the end of the day, Jay, the IRS is always going to look at intent first and
Yep.
foremost. That's going to be the number one thing is that they're going to ask themselves, what is this person trying to accomplish by doing this, right? That's
Right.
going to be one of the first items they're going to consider. They'll look through veils, they'll look through straw hold transactions. See, I sell the real estate to my buddy who sells it back to me, right? Like none of those would necessarily hold up, right? Um, even if people are trying to think extremely creatively with like different entities and the like, at the end
Yeah.
of the day, they are veils, and yeah, the IRS will go ahead and look at that intent.
Got it. Very cool. No, this was awesome. Again, folks in the audience here, if there are any questions, please unmute yourself and ask them. But in the meantime, until we hit 9 p.m., I'm going to try to ask as many questions I can because this is pretty fascinating to me also. Now, you mentioned that Equity Trust is one of the largest custodians, actually the largest custodian. Can you tell me a little bit about what's the risk of not working with a well-established custodian? Like, is there any fraud that could happen? Like, what are some of the risks working with someone? Are
Yeah,
there any licenses that you're required to have to be a custodian?
yeah,
Tell me a bit
good
more about
questions.
that.
Good question. So the custodial angle really lays down to the banking aspect, right? And
Yep.
that's what we are is we're a bank here um, through the South Dakota Division of Banking, right?
Mhm.
So it's very important that you're working with somebody who's solvent and who has cash.
Yep.
Um, I have seen groups exit the industry due to poor cash management, right? Due to probably too much leverage. I think that would be safe to say.
Mhm.
So you want to make sure you're working with a solvent business, right? And I think our size helps stand by that a lot. Um, there are a lot of small mom and pop custodians that are two guys in a truck, right?
Yeah.
Not that there's anything wrong with a startup. I've worked for plenty. Um, there's just more risk involved
Right.
with that, right? I mean, you'd be working with a newer entity, and but really, I think one of the biggest differentiating factors is do you have a direct point of contact, and is that
Right.
direct point of contact are they actually seeking to learn about your goals, right? Like, are they willing to have that goals-based conversation, and what does that look like? Because a lot of groups they're self-serve and they're all electronic. So like there are some custodians that don't even have the phone tree, where
Mhm.
everything is done completely via email back and forth, right? And for
Yep.
some people that's wonderful, for some it's not. But having that direct point of contact, I would
Yep.
say outside of financial solvency is going to be one of the bigger items
Mhm.
when
Mhm.
looking at a custodian. And then those who offer those differing products, right? Because it's not a one size fit all approach, and it's never been. Um, so you want to be able to have options, right? Depending on what your financial goals are and what you're trying to achieve. So ensuring you're working with a custodian that has the ability to offer you all of those products in-house, I would say would be another item to strongly consider.
Right. But in the rare circumstance where the custodian does decide to leave the business, as you mentioned, some of the startups that you had seen, the
Yeah,
the money that the investors have is actually invested in the assets, in the real estate, or
correct.
it's not
Correct.
with the custodian. So there is
Correct.
no real risk to the investor, correct?
You're exactly correct. What
Okay.
would happen after the fact would be known as an in-kind transfer.
Okay.
So they would go ahead, you would call, let's say a custodian goes out of business, right? You have your IRA with them. You would give me a call and I would help you with the re-registration of your paperwork. So we
Got
would
it.
then go ahead, be your new custodian, hold that asset on your behalf, rather. It's a fairly simple process. Takes about 2 weeks as well. So those timelines are consistent in the re-registration of that paperwork, but certainly something we can help solve for.
Perfect. Amazing. Great. I think we are pretty much at the top of the hour. So if there are any last minute questions, going once, going twice, questions? If not, I think we will close this webinar. We will be sharing the recording, and then we'll share the recording with you as well, Paul. So feel free to share along with your audience as well and on your social media. And your email address and phone number is on the screen. So we'll make sure to include this in our newsletter that goes out on Saturday as well. So you might have some of our investors reaching out with some questions and getting a SDIRA account set up, hopefully. So thank you
Well,
again
Jay,
for joining us, and really thank you for sharing all the information you did today. So really appreciate it.
thank you, Jay. It's an absolute pleasure getting to work with you and Andy and Prosper Capital, and just want to thank you again for the opportunity. Very kind of you.
Absolutely. Great. Thank you, Paul, and thank you all so much for joining us this evening, and hopefully we'll see you all on our next one. Thank you and have a great evening.